Okay, good morning, everybody. And hi, Diana. Can you hear us?
Yep, hello.
Hey, good, okay. Our focus this morning is on trends, particularly with venture capital, but we've got such a diverse panel that we'll probably cross over into some other areas. I'm going to introduce myself and then let the other panel members introduce themselves. And then we'll sort of go from there with what we're seeing in the venture capital space, and then more particularly with each person's expertise. So as Marty said, I'm Sherri Haskell, Capital Dynamics Consulting, and my background is pretty broad in the capital markets. I started off as a stockbroker and then transitioned into owning and managing a hedge fund, and then from there into private equity. And shortly thereafter, I actually launched an angel consortium investment fund, which is still ongoing. And by the way, I was senior VP for a family office for a few years before the angel consortium. So it's a pretty broad background. And now with Capital Dynamics Consulting, I've taken all that pool of information and knowledge that I've accumulated over the years and using that for a number of different investor classes, but very much focused for the family offices. And what we do, and you can see on the website, Capital Dynamics Consulting is a pretty broad area of sourcing, of putting together campaigns, of due diligence, and a specific area that I sort of am proud about, and that is transaction forensics. A lot of, I would say quite a few families and individual investors have come to me over the years and said, hey, I'm thinking about doing this particular investment. Would you do me a favor and look at the transaction, look at the documents, let me know if there are any hidden surprises in there that I should know about. And I love doing that. So I'm going to move this on to Rupam, and you can talk a little bit about what you do and your fund, and then I'll get back with questions.
Okay, thank you, Sherri, and thank you, Marty, for having me here. I'm Rupam Shrivastava. I'm a founder of a VC fund called Frontiers Capital. We invest in early stage technology companies. Our focus is what we call exponentially growing technologies, by which today we mean AI, robotics, quantum computing, blockchain, a little bit of AR, VR, and some biotech as well. So we like technologies which have that exponentially growing path in front of them, perhaps to a $1 trillion market cap or a market size within 10 years. So AI definitely fits the bill. And these days we are investing a lot in generative AI. That is the way we caught it early. We had investments in foundation models. We're looking at applications, but we're looking at Gen AI infrastructure, which we think is the most, has the highest risk reward today. So my background, I've been in the VC space for the past 20 years. I'm a scientist myself, so I like those kind of early stage deals, which are science and research heavy, and science and technology heavy. And my firm, Frontiers Capital, we invest in early stage startups. And we like companies that are founded by professors, researchers, scientists, where we are almost sure of the technology. So we like to invest in the smartest people in the world in their fields. And typically these are professors, researchers, scientists. And many of these professors are on their second startups, which is the ideal kind of entrepreneur that we like. People with the technology and science and research moat, that global advantage, with an entrepreneur's DNA, and we like to call them scientist entrepreneurs. Those are our favorite startups. So that's the focus. That's what I've done for the past 20 years, and this is my main fund.
You know what? That's a pretty broad. That's a very interesting and very precise portfolio that you've got. And I'm just wondering, at this moment in time, is there a primary focus? You mentioned AI. And when we spoke earlier, you talked about quantum and you talked about blockchain and some things like that. So right now, just before we get into the bulk of this, is there a primary focus that your portfolio is looking at and holding?
Yes, the primary focus is generative AI. And we remain nimble because our fund is designed in a way that we can change with the times. So when we launched the fund in 2020, our first fund, generative AI was not a buzzword, but we were investing in AI at that time. We made certain blockchain investments as well. Actually, our blockchain investments have done really well because that's a fast-moving industry, and exits are faster. Our AI investments are next in line. So it's generative AI right now, and we remain open to change with the next wave. That's the fund mandate. So we remain quite flexible that way. So around 60 to 70% of our investments are AI, and the rest is quantum, blockchain, AR, VR, a little bit of biotech.
Is it all software?
All software, yes.
Okay.
So it's
And
like deep
Eric?
tech software.
Deep tech software. Yeah, we like capital efficiency, we like scale.
Eric Hsu, why don't you go ahead and tell us all about what Eric is here as a partner of the firm, Wilson Sonsini.
Yeah.
And so why don't you tell us about your focus and what you're doing?
Yeah, thanks Sherri for the introduction. So I'm Eric Hsu. I'm a corporate securities partner at Wilson Sonsini. I myself practice, startup representation, venture finance, M&A, capital markets offerings, public disclosure, corporate governance. Wilson Sonsini is an international law firm focused on technology, life science, startups, investments. We have probably 12, 13 offices in the U.S., 5 or 6 offices internationally. Represent some of the biggest startups in the world, including Google, LinkedIn, Twitter, Apple. So there's a huge breadth of experience that we have in terms of helping startups get formed, get financed, getting to the point of an exit, whether that's M&A or going public, and then kind of all the public company representation of those companies right in the public markets. And I'd say that just before we get to the real deep part of it, I myself focus on life sciences and technology companies, and I'm finding there are a lot of companies right in the life sciences space, pharma, biotech, that are starting to use AI to try to complement or supplement their existing technologies, or has a platform that is based off of it. And I think that's both a combination of they want to continue to evolve, but also there are some funds that may have a limited ability to kind of invest in traditional life science companies. So you add sort of a digital health component, right? AI component, also in the realm of potential investors.
Right, so it enhances our attractiveness to a broader audience.
That's right.
Gotcha.
And I think the hard part is to identify which of these companies is kind of thinking about AI in a thoughtful manner versus ones that are just kind of tacking it on, right, to find another way to just access
Boy,
the capital.
it is a huge pool for us to work in, to play in, and try to navigate, and then to try to guide in a productive way. Dianna, tell us a bit about what you're doing.
Sure, thank you. Thanks for having me here, Artie. And so I'm Dianna Raedle. I'm CEO and founder of Raedle Group. And given the AI discussion, we're very actively applying AI to capital markets activities. So Raedle has been in business since 2007. We've helped organizations raise over $5 billion in capital. We actually provide unbundled services, so preparation, kind of like outsourced, tailored CFO to think about how you're going to market the capital markets. Then we have a fintech solution that enables capital seekers from their own email address, we think, from their own name, to be directly in touch with their relevant subset of over 17,000 US investing organizations with 99% deliverability. And then we do have a broker dealer, and we can do things the old-fashioned way, but we don't really think that's the most effective way. Anyway, for the AI component, since we're all talking about AI, what we've done is we've created a capital markets communications assistant. And we have a 4-pillar framework for thinking about preparation, which is positioning, forecasting, supporting all those things in the competitive framework, competitive landscape. And so we've trained this to basically do all sorts of writing your emails for you, doing presentations for you. And essentially you can give it doing competitive analysis for you. You can give it 3 or 4. We have set prompts related to our pillars, and then you can give it 4 or 5 sentences, and it will write, your update email, your introductory, your presentation. It's really quite incredible. Pretty excited about that.
Well, okay, thanks so much. It's very interesting. We've got a diverse panel here, and because our topic is trends with venture capital, what we heard yesterday quite a bit, and I'm going to continue with that because we've got different perspectives here. Because the IPO market has condensed in the last few years, we see that venture capitals are resorting to other ways of satisfying their LPs in the way of providing returns and liquidity. So there's a number of vehicles that we're seeing implemented here. I'm going to talk just a little bit about them, and then I'm going to give them to the pros in that area. As I mentioned, there is a lack of IPOs as of the last 2 to 3 years. And just to give you some real metrics on that, I did a little research, and it seems that what I've found is that in the early 2010s, the median time frame from entry to venture capital to exit was about 5 years. From the 2020 until about the 2023 area, that time had extended to 7 to 8 years, and now it can be even in excess of 10 years. So you see that the private companies are staying private longer. And we can talk about why that is in addition to the lack of IPOs. M&A, which Eric works in, is another alternative because there's a shorter runway for M&A exit, a type of exit. So again, we're looking at what the VCs are doing to provide some liquidity. And one of the big things that we're seeing, and we talked about quite a bit yesterday, was secondaries. Okay, the secondary market has become much more dominant than it was, when I got into this. And even in the last 5 years, I would say it's really taken a front seat in the alternatives. Some of the reasons I didn't go over, some of the reasons that we're seeing the companies stay private longer is uncertainty in the marketplaces. Your speaker was just talking about that. Regulatory hurdles that make it very difficult and costly for a number of companies to go in, market volatility and things like that. So talking about secondaries, there's so many things that satisfy both the VC and the investor to start looking at that as an alternative. And we can talk more about what those particular things are. I'm seeing things like crypto staking, which Rupam can talk to us about. Let's see, M&I, charitable organizations. Dianna is a pro on that. She can talk to us about that. VCs are also offering co-investing as another way to attract investors, partnerships, alternative financing vehicles, we can talk about them, which provide recapitalizations as well. So Eric, because I talked about M&A just a moment, that's your area of expertise. Why don't you talk to us about what you're seeing and how that compared to maybe what you saw in the past?
Yeah, I mean, I'd say kind of right when COVID began, about 5 years ago, right, 4 or 5 years ago, there's kind of this uptick in, kind of, I'd say like money, right, where companies had maybe more optionality in terms of whether they want to try to go public, whether they want to stay private. And I'd say that there are a lot of companies at that point in time that, access capital via the markets, in positions that they should have. Now, because of, like you said, the markets are kind of more volatile, kind of less money is accessible. I've been seeing a lot more, I'd say, like strategic, opportunities by acquirers to come in and try to like be selective about the companies they're taking off on. I'd say like probably more favorable terms than had existed, 3, 4, 5 years ago.
Really?
Yeah, and so I'd say like there's some more distressed transactions happening just because you have companies where they need capital and they can't get it, right? Or it's a lot more limited in terms of, a lot more belt tightening going on at companies. And so because of those circumstances, they need to find a path of either a liquidity or an exit, right? Or something along the lines to kind of keep them alive.
And how are you seeing the valuations affected by this?
I'd say it's been depressed, right? I'd say that again, like back when there's more kind of capital flowing, valuations kind of were exponential in terms of, what I'd seen kind of prior to that point in time. Now I'd see it's either kind of flattened out, right, or gone down. In some cases where you have investors coming in, it's maybe like a disguised flat round where, kind of on paper, right, that they see the same value, but then they add in a lot more warrant coverage or, preferences, right, multiples where, they're kind of paying the same price, but they're getting more for the buck.
Are those equity rounds or are they debt rounds?
I'd say both, right? Multiples on debt rounds for like a change of control, right? Discounted, lower valuation caps in those situations for like debts or safes, and then equity rounds, right? So flat round on paper, right? The same, post money from the last round, but then again, there's like warrant coverage.
I was just gonna ask about warrants and liquidation rights and things like that. Have they changed a bit?
Right, what's any nuances in the agreements?
Yeah, it's definitely more investor friendly than how it was, a few years ago, right? Both in terms of valuation, I think they're being depressed, as well as again like multiples on the liquidation preference, rights like that.
Do you see that more in one industry versus another, or is that pretty much across the line?
I'd say that the depressed valuations is probably across the line. I'm seeing a lot more, I'd say, like insider-led rounds as well, where they try to first, keep the company alive, but then they kind of, I'd say, like prepare, like a term sheet, like a straw man term sheet to go out to outside investors with, to get one of them to come in and help them support the company. And I'd say that, the interest level is kind of there, but the follow through is not, where you have a lot of outside investors, they have their own existing investments in portfolio companies that they got to support. And so it's hard for them to take the lead, right, and put in the bulk of the money, right, and be the first one over the line. They're all kind of sitting back and saying, I will co-invest along someone else, but I'm not going to be the lead. And it's really hard to find someone that's going to take the lead.
That's so interesting. And are the types of venture investments that you're seeing now different, or any alterations in what you saw from previous years?
I'd say the early stage stuff, I'm seeing a lot more like safes, right? Previously, used to be, convertible notes. I'd say the past 10 years, the Y Combinator form of safe is probably the easiest way to get money into like a.
It's so interesting.
company.
Talk to us a little bit more about safes, because especially in my angel consortium, we see that coming and going. There's a popularity for it and then a pullback. And there are advantages and disadvantages from both sides of the table. If you could address that for us.
Yeah, so I think, like a safe investment is probably the, simplest form of getting money into the company in a, I'd say like written documented form. Basically, it's kind of an investor puts some money into the company and it converts upon a next round, financing occurring. And I think, traditionally, right, there used to be just a flat discount to the next round. Now it's more of a, post money, valuation cap is kind of what I've been seeing more and more often. Kind of meaning that, that there's a kind of a cap on how high the valuation is for the note to convert, right? So it can go up to, 10, 15, $20 million.
And it can be structured any which way.
Yeah.
And
it's a lot easier for, I'd say, smaller investments to come in as well, from like angels, high net worth individuals, angel groups where you don't need to have as much negotiation, right? There's just, like, Y Combinator forms commonly accepted as the industry standard.
And there's no particular maturity date.
Yeah.
There's no,
it's not
demand
liability.
on payment of anything.
Yeah, it's not, unlike a note, it's not a liability on the company's books, right? There's no maturity date, like you said, no expectation on when it's going to be repaid other than upon a liquidity event. Really just sort of kind of park the money until a future investor has done the diligence to price out the round.
And it's interesting. I mean, I see the advantage definitely for the entrepreneurs. It's interesting that there's been so many investors that are willing to go forward with that.
Yeah, I mean, Rupam can speak to his experience and his perspective, but I think it's just like the ease of putting money into the company, right? For a lot of investors, I'd say that a $25,000, $50,000 investment, kind of on terms that will be negotiated later on, is not that hard to swallow.
And the key thing is, I'm remembering now, is valuations. You don't have to put a valuation on a safe at origination.
Yeah, you're deferring that decision to like a future point in time.
It's interesting. Yeah. They're very flexible. Rupam, as Eric was saying, tell us more. I mean, you've got a whole nother perspective and I would love to hear more about your, of course, everybody wants to hear about your AI investments. And you've got a broad portfolio, but is there a particular area of AI that you're especially keen on?
Yeah, so just to add to that point on safes. So in my world, because we are in the quote unquote the hottest investment areas, the entrepreneur still has the power over investors. So rounds are almost always safe because they are the easy ones for the entrepreneur, and they almost always close within a week. There is a rush for lead investors to get in. We typically are follow-on investors.
Okay, that's really interesting. And then tell me about, I'm sorry, this is exciting to me, your criteria for curation, for selection of your companies.
Yeah.
Talk about that a bit, because there is a plethora of all of these companies rushing to the market now.
Yes. So over time, we've gotten really methodical about how we get there. So we have our own proprietary algorithm, which reads all the scientific and research papers publicly available on the internet in the areas that we like. So whether it's AI, blockchain, and so on. And our algorithm flags the hottest research papers which are going viral in the scientific community. Perhaps the normal user might not even understand it, but the scientific community sees that this is a real innovation. We look at the authors of those papers. Those are typically professors, PhDs, researchers. We add them to our network. So the past 10 years, me and my partner, we have been working with these professors. We sometimes give them grants. Other times, we are just talking to them, discussing their technology, discussing their latest paper, which is catching fire. So we have this network of professors, researchers, and there are around 200 of them, most of them US, some international, and that is our deal flow source. So sometimes these professors are starting companies.
Yeah.
Sometimes they say, hey, my PhD student just graduated, he's looking to commercialize his idea. Do you guys want to talk to him? And sometimes that PhD student is the next big entrepreneur. So we have this network of what we call scientists, entrepreneurs, really smart people in their fields, doing path-breaking research, and we stay in touch with them, just have conversations, nothing serious, and an idea pops by. And
Is that like a Telegram network or?
It's mostly face-to-face.
Okay.
A lot over Zoom as well with East Coast universities, but Stanford, Berkeley, MIT, Princeton, Caltech, that's where most of our professors are. And we try to meet them as much as possible, otherwise Zoom calls and so on.
So they're super early
Extremely
stage.
early. We like to say that we want to find an entrepreneur before he has even thought of starting a company. Because as soon as he launches, every Silicon Valley VC is on top of it.
So then that leads me to, because I deal with investors so much, that leads me to how are you convincing your investors to come in at such a high risk? And talk a little bit about the structure of your fund. It's a different kind of structure.
Yeah, so it's a venture fund, just a typical venture fund.
But it's public-private?
Yes, that was our first fund. Yeah. So we have a public-private hybrid structure, and now we are launching like a venture fund because the public-private fund, the private portion did so extremely well that we now have inbounds for a private-only fund. So our private portion of the public-private fund is sitting at a 6x TPPI in the first 3.5 years. So now we have more demand for that. It was almost an incoming demand by larger investors who are interested in that portion. So we're launching a ventures-only fund, which is a typical 10-year fund.
What's the size of that fund?
So this new fund that we are launching is 35 million. The previous one was 60 million, out of which 1/3 was private. So 20 million earmarked for private and 40 for public. So we're just building on top of that track record by perhaps doubling the size. We write really small checks. So we are also limited by the opportunity. If you give me $500 million, I'll find a hard time investing.
Call me.
We write small checks. We are typically the first check. We try to get into the friends and family round where VCs are not even looking. We can write checks from 50K to $500,000.
This may be a silly question, but I was thinking about it when I was reading about what you're doing. Is your fund, or your portfolio, I should say, your portfolio companies strictly US, or are they international as well?
So till now it's US and Canada, but we can do international. Our remit is international.
Interesting, interesting. I'm going to move a little bit to Dianna because Dianna, when we were talking, you had brought up the charitable organizations as another alternative, a trend that you're seeing. Tell us about that and how it works and why you think that's coming up now as a trend.
Sure. So, so essentially what's happening is that charitable organizations, so foundations, are launching funds, for-profit funds, to invest in technologies or other aspects of, companies that have, sort of mission-aligned purposes, but are actually for-profit companies. And part of the reason that they're doing this is so that they can expand their reach into companies that typically can't get funded necessarily because they don't really have the right financial dynamics for more traditional capital partners are important to solving some of the big problems. So cancer is an example where, if you have a certain cancer that only has 2,000 potential users, people who suffer from this cancer, it would be very hard for a for-profit company to, invest in trying to solve that cancer. So basically, the charitable organizations are stepping up and thinking, how can we expand our reach into some of these companies that, might be in the death valley, the valley between Series A and Series B and Series C, and where we can, invest without pure profit being the measurement of success, but impact is also part of the measurement. And I think it's very interesting because, if you can get onto the mission side of the charitable organization, then the fact that you're, creating some return but maybe very high risk return is compared to the, more traditional person who's giving to the organization who doesn't expect any return whatsoever. Right. So I think a lot of people have, thought about launching or have launched impact funds. And I think, when you the traditional investors in funds, asset allocators, they're not so impressed with it because they have a fiduciary responsibility, even if it's within an organization, right? So a pension fund has the regulatory fiduciary responsibility to generate returns for their pensioners. So there's a lot of barriers on when you're going to those investors for them to invest in what would be really an impact fund. Whereas if you go to the charitable organization donors, and now they have a potential for a return, then you've changed the dynamic significantly, I think. And I think, why is this happening now? I think people have thought more about how do you create a mission-aligned or program-aligned fund so that it can come from the charitable side, or so it can be aligned with the charitable mission.
That's so interesting. Marty, do you have, because you always have questions.
No, because Dianna and I are teaming up on this. But I think it's
Partners in crime, huh?
right. This has to do with some of the nonprofit work that we do in what I call the Mike Milken model. So
Okay.
right, which is that when Milken funds philanthropic research that pays off, he then invests in the company ahead of everybody else. So he's made more money probably from his healthcare investments than he's made originally from the Wall Street bonds business. So,
Interesting.
yeah. Yeah. But I did actually have a follow-up of Eric on the secondaries.
Yeah.
So when secondaries occur, is it possible, like those transactions, they're done in, back rooms, smoke-filled rooms, et cetera. How does the data get out? I mean, is there like a central place that collects all the data on secondaries?
I mean, those are all like private transactions, right? I mean,
Yes.
I don't know how the data gets out, right? Maybe, companies kind of self-report that stuff as it happens. Maybe there's like some sort of banker involved to kind of act as an intermediary, but I don't know how that information gets out other than
We
self-reporting.
spoke a little bit yesterday, or it came up yesterday, about potential funds for secondaries.
Right, those are continuity funds, but I don't think they're in private equity, but they are not in venture yet. I don't think so.
But with the venture side, I think the more famous companies like you can always get a secondary in space. Like, they're raising every year. So most of the AI startups, Cohere, Anthropic, all of their new runs for all those out in the market. So even as an angel investor, if I decide to put 10K in of all of them, I get all of their secondary information. So sometimes you can get it that way also because they are so public and almost every retail investor has access to them.
There are a few secondary platforms that are offered.
The platforms
Yeah,
are the
and
big
I think the
But
data.
I mean, even it, right, but none of those are required to report to the public,
Oh,
right?
yeah.
So I mean,
Right.
it's maybe a pitch deck will collect stuff, but that's long after the fact, I think. Probably
Yeah,
quarterly at most.
Yeah, pitch deck is late by a quarter in almost everything. Yeah.
Right. Or more.
Interesting.
Or more.
But my other question on the second is, are there any special agreements in secondaries acquisitions? I mean, and again, any nuances, just like in the, when people were doing bridge rounds, they might get more warrants. Is there anything in the secondaries agreements, that might be occurring that people should be watching out for?
I mean, I'm not aware of anything special, right? Sometimes, not exactly answering your question, right? But there's like the traditional, right of first refusal agreements that you have with like other parties, right? Other stockholders in the company that prevent, as a first step, you just going out having your own private negotiated secondary without having others kind of brought along or being offered to them. I'd say that, sometimes we've had situations where, kind of founders maybe join part of that transaction with the idea that you can kind of upscale the founder stock to like a preferred stock as a part of the sale alongside another equity round. So there's kind of a variety of things that you can kind of get as like a secondary.
Well, right, and plus there are different players in each kind of secondary field. You've got people that are in the venture capital that are providing secondaries. You've got private companies where the private company might see that as another form of financing. The C-level people might also see that. They might find secondaries a way to provide benefits to some of their top employees as incentives for them.
Yeah,
I mean, there's a
IPOs
number
are
of
so
different,
late,
right.
and employees want liquidity.
Yeah. So there's a number of different players at different levels that I would imagine, and I'm sure do have different contingencies and so on that would be built into them. Another a question I have for you that I thought of when you said about not taking super big checks, but if somebody came to you, an investor came to you that was, what we used to call whales, sorry, a large investor, a significant investor, would you allow co-investing directly in parallel to you into a company, or maybe your companies are too early stage for that?
Yeah, I would say it's very hard because to even get a co-investment allocation. So these are rounds that happen quickly. We can't like share a DD deck with the investor and say, oh, do you want to co-invest?
No.
Or even the deal details. Sometimes we ask for a 250K allocation, we get 125. So the hot deals, they don't get shopped around. You're almost running to get yourself in, because the lead investors, they want to take the entire round. If the company needs 10 million, General Catalyst might say, I want the entire 10 million. But because people like us have had relationships with the companies before, we can get a $500,000 check in. But we don't have any room to expand it to $1 million. And I almost—
Do you typically come in as a co-investor?
We follow. We let General Catalyst dictate the deals. And that is also one of the value adds we bring to the company, because we are still a small fund, not ready to write big checks, but we can introduce them to the big guys. And the big guys like working with us as well, that we bring them some nice deals. So we just make sure our allocation is set. And this way, I think we have a certain advantage over the big players, because Sequoia can only lead so many deals. If they don't lead a deal, they just don't even participate. We can participate in all of them, as long as we knew the founders, because we are follow-on investors. We don't care, are we the lead and are we the big guys in the room? We can be the small guys, but participating in almost all the deals. As long
as you take a piece of the deal.
As long as we take a piece of the deal.
Right.
So we are more flexible that way.
And I have another question for you. Sorry, this whole AI thing is very intriguing, I think.
About 10 minutes.
Okay. I think to everybody, I've been reading lately about the reasoning model that I guess the new OpenAI, they call it Strawberry, but it's what do you think about that?
So reasoning is a spectrum. So you can go from what OpenAI was or GPT-3 was at an undergrad high school level to an early PhD grad student level. So reasoning is a spectrum in certain areas. Factual reasoning, it's very good. Subjective reasoning, it's not as good. It hallucinates a lot. So I think this is sort of would be industry specific, where if you need factual data, it's very good. Subjective data, probably not so much. Then there's also repeatability. That's the big issue we are having.
But I mean, would this be an area of interest for you, or is it
No,
too?
no. I'll tell you why. So GenAI, we divide it into 4 categories. So one are models, foundation models, people working on completely new paradigms. Next are applications, where chatbots are really big right now, but then there are other kinds of applications. The third is infra. So a very interesting tidbit here is that there is a metric called flops utilization. So today, even if you have the best NVIDIA GPUs, the rest of the memory and the infrastructure around it is not enough to have 100% flops utilization that a GPU can offer. Today, it's around 30 to 50%. So that is where a lot of work needs to be done. The infra around the GPU is still slow. GPU has gotten to 100x speed. The infra around it, the memories and the connectors are at a 10x. So we like this infra space. We just invested in a startup which is into the embedding. So how the data is actually embedded before the LLM comes on top. And we've just had a 5x markup on that because we like that play. Every LLM foundation model creator needs that kind of embedding because it sort of speeds the LLM's performance.
Interesting.
So we're doing this AI, right? So we're doing this AI, and basically, I would say it is about like training an intern. So it will, it will learn something and then unlearn it, and then you're like, wait a minute, we already agreed on this. So, and it will also, in the level of the data that it takes, and this is ChatGPT 4.0, I guess, or, the GPTs, and the level of the knowledge or the level that it can learn is very, very high level still. Like it cannot do specific analysis in a way that is very detailed in a vertical. Right. So if you ask it to scrape for, not scrape, but analyze like 3 websites and compare them, it will tell you at a very high level. Like we asked it to compare our approach to Preqin and PitchBook. And so, at a very high level, it said, you guys are, providing services around the data, and PitchBook and Preqin are providing data, which is true. But, about the level that it can analyze. So it was great. It's like, wow, it caught that. At least that's highlighted on our website. But it doesn't get much more deep than that. So there's so much more to happen, but it is also very cool what it can do, even at this level.
And
I'm sorry,
just a quick point. Just as we train humans, so everybody up till high school has the same education. After that, we need specialized people. We need engineers, we need lawyers, doctors, journalists. So that's where ChatGPT would go. It would go to an extremely smart high schooler. But then if you wanted to do real things, you need to train it as an engineer. You need to train it as a lawyer. And that's what we do. And that's what we would end up doing with these models. Specialization.
So I've been given the signal by Marty that we're on the clock now. I'm going to go to each panel member and see what your parting thoughts are, what you'd like to tell.
I actually had a question for Dianna. We got about 5
I
minutes.
know you have questions.
Dianna, can you talk about why you unbundled this investment banking product? I mean, I think that, you said that you've kind of segmented into different things and how that works for you, and does it create a funnel for you or what? Can you talk about that?
Yeah, sure. So basically, we feel the capital markets have changed, and for most capital providers want that direct contact to their capital, whoever they're providing capital to. They want to understand who they are. They don't invest because of intermediaries anymore. This idea of relationship transfer. And this is for the institutional market, right? So these are people who are fiduciaries who have to convince a team to make the investment decision. And so within that framework, what we said was, how do we help people be relevant and make, get capital? And we also say that, the environment previously was like, if you have a ski mountain, it was full of all green slopes. So you could grab your skis, you could run out, could ski down, and you feel like you're skiing. It's now a mountain full of only double black diamonds. So you have to know the fundamentals. You have to really know how you do it. And so our process was essentially to say, okay, what is relevant for a close? And again, this is based upon $5 billion of raising capital. So we say preparation, connectivity, and long-term, consistent investor engagement, and then closing. And so what we wanted to do is we wanted to be relevant for the whole process. And so for preparation, like I said before, it's kind of like a tailored outsourced CFO. And I am actually now an outsourced CFO for a battery recycling company. And so it's the strategic nature of the preparation we think is very important. And then the connectivity, we believe, is like every other industry. If you're buying crackers or whatever, Nabisco spends so much money educating you on who they are and building their brand. We think the same thing. And, in the public markets, the companies that do the best investor relations have the highest valuations. So we think the same thing, that those are the fundamentals for truly selling something, anything, even capital. And so what we did was we set up this methodology to enable capital seekers, funds or companies, to be consistently in front of their potential investors and deliver that message, build that brand over long periods of time. And just, when you need capital, you're already in front of these people. They already know who you are. You're already starting that relationship building and that investor engagement. So you're way ahead of the people who just started yesterday. And then closing is typical. But each one of these three, as to Marty's point, is separated and is unique. And, you can engage any of the three or all three, depending upon the needs that you have for getting into the capital markets.
We have a question.
Yeah, Diane, my name is Maureen Downey. What size of fund or company do you think you have to be to make this, like, your product economically viable? Like, how much capital do you think you need to raise or be raising over a period of time to kind of justify maybe the cost?
Yeah, so basically, actually the cost is very competitive because we have divided the services. So we say you have to be institutional in nature. So you have to be able to talk to and have materials that support talking to institutions.
Mm-hmm.
And then, we've done everything from a $2 million raise up to a $7 billion fund. And what we do is we have tagged and can filter, sort of using AI first, and then, some more specific things for all 17,000 organizations by their type and size. And then we essentially say, hey, think about who you want to be in your capital universe over the next 5 to 10 years, not who you wanted yesterday. And if you think about who you want to be in your next 5 to 10 years, you realize that universe is reasonably broad. And so we say, even if you're a young company, get out there, like start raising your flag, start telling people who you are so that they can start to follow you.
Okay. Yeah. Eric, did you want to give us some closing comments about what you're seeing?
I mean, I think we'll kind of, hopefully the markets will improve over the next, 6 to 9 months. I think the Fed, like, lowering the interest rates is like kind of one of the signals that, things should, start to improve. Deflation, or inflation should, hopefully start staying flat or declining, staying around wherever it is right now. Hopefully that will, encourage investors, right, to kind of put their capital to use, right, so just sitting on it. And I think all that activity is good, right? It'll hopefully, cause, rising tides lift all ships. And so hoping that by that impetus to kind of, try to loosen up the capital, that, things will improve.
Thanks. Rupam.
Yeah, I think staying on the topic of Gen AI, one interesting analogy I want my audiences to leave with is OpenAI, ChatGPT, all the LLMs. They are like almost the Netscape Navigator of 1995 or 6. That was the first and the only easy way to access the internet for the whole world, not just for the experts.
I actually remember that.
And anybody with a computer and an internet connection could access the internet. And today, anybody can access a really smart LLM just through an API or just with an app. Now, what where the monetization comes is up to the smart entrepreneurs, and even after Netscape, it took a few cycles to get to the right business models. The infra is being built up, just like the internet times, Cisco and Juniper were building the routers and fiber optic networks. Here, the infra of GPUs and cloud servers has been built up. Now the monetization is the next game, and where smart entrepreneurs will figure out how to monetize this. So that those are the parallels I see from a technology.
You've got your work cut out for you.
I got my work cut out. Yeah, things are moving fast.
Yeah.
And we are busy all day meeting new people, reading new research papers, and seeing where the tax.
Exciting. Yeah. And I know that we've got the next panel lined up, so I'm going to be quick. Again, I am the CEO and Chief Catalyst for Capital Dynamics Consulting, providing a broad spectrum of specialized services for a number of different investor classes, but we're very much geared toward family offices. Check us out, and thank you, Marty.
Fantastic. Well, thank you so much.